Welcome! Today, we're diving into a topic that affects everyone, whether you realize it or not: inflation. You might have heard the term on the news or seen prices rising at your local store, but what does inflation really mean? And more importantly, why should you care? In this video, we'll break down the basics of inflation, explore how it impacts your daily life, and discuss why understanding it is crucial for making informed financial decisions. Let's start by defining what inflation actually is. Inflation is the general increase in prices of goods and services over time. Imagine going to the store and noticing that your favorite snack costs more than it did last year. That's inflation in action. It's not just about one product, though it's about the overall rise in prices across the entire economy. When inflation occurs, each unit of currency buys fewer goods and services, meaning your money loses some of its purchasing power. This is why economists and policymakers pay close attention to inflation rates. To understand inflation, we need to know how it's measured. Economists use tools like the Consumer Price Index, or CPI, which tracks the prices of a basket of common goods and services over time. By comparing the cost of this basket from one period to another, they can calculate the inflation rate. This rate tells us how quickly prices are rising and helps policymakers make decisions about interest rates, wages, and more. Accurate measurement is key to understanding the real impact of inflation on our lives. So, what causes inflation? There are several factors. One common cause is demand-pull inflation, which happens when demand for goods and services exceeds supply. Another is cost-push inflation, where the costs of production rise, leading businesses to increase prices. Sometimes, inflation is influenced by monetary policy, such as when central banks increase the money supply. Each of these factors can contribute to the overall rise in prices, and understanding them helps us see why inflation isn't always straightforward. Let's take a closer look at demand-pull inflation. Imagine a popular new gadget hits the market and everyone wants one. If the supply can't keep up with the demand, sellers may raise prices. This is demand-pull inflation in action. It's often described as too much money chasing too few goods. This type of inflation can occur during periods of economic growth when consumers have more money to spend, pushing prices higher across the board. Now, let's talk about cost-push inflation. This happens when the costs of producing goods and services go up. For example, if the price of oil rises, transportation and manufacturing become more expensive. Companies often pass these higher costs on to consumers by raising prices. Cost-push inflation can be triggered by factors like wage increases, supply chain disruptions, or rising prices for raw materials. It's a reminder that inflation isn't always about demand sometimes. It's about the cost of making things. Another key factor in inflation is the money supply. When central banks, like the Federal Reserve, increase the amount of money in circulation, it can lead to inflation if the growth in money outpaces economic growth. More money chasing the same amount of goods and services can drive prices up. Central banks use monetary policy tools to try to keep inflation at a healthy level, balancing economic growth with price stability. Sometimes, inflation can spiral out of control, leading to hyperinflation. This is when prices rise extremely fast, often by hundreds or thousands of percent in a short period. Hyperinflation can devastate economies, wiping out savings and making everyday goods unaffordable. Historical examples include Zimbabwe in the late 2000s and Germany in the 1920s. Hyperinflation is rare, but it shows why keeping inflation in check is so important. On the flip side, deflation is when prices fall over time. While this might sound good at first, deflation can actually be harmful to the economy. When people expect prices to keep dropping, they may delay purchases, leading to lower demand and slower economic growth. Businesses may cut wages or lay off workers, creating a negative cycle. Both inflation and deflation have their risks, which is why stable prices are a key goal for policymakers. You might be wondering, why does inflation matter so much? The answer is simple. It affects your everyday life. Inflation influences the cost of living, the value of your savings, and even your wages. When prices rise faster than your income, your purchasing power declines. This can make it harder to afford essentials like food, housing, and transportation. That's why understanding inflation is important for everyone, not just economists. Inflation can erode the value of your savings over time. If the interest you earn on your savings is less than the inflation rate, your money loses purchasing power. For example, if you have $1,000 in a savings account earning 1% interest, but inflation is 3%, you're effectively losing money in real terms. This is why it's important to consider inflation when planning for the future and choosing where to keep your savings. Wages and inflation are closely linked. If your wages don't keep up with rising prices, you may find it harder to maintain your standard of living. Employers sometimes raise wages to help workers cope with inflation, But these increases don't always match the pace of price hikes. This wage-price relationship is a key reason why inflation is a concern for both workers and businesses. Inflation also affects borrowing and lending. When inflation is high, the real value of money repaid on loans decreases. This can benefit borrowers who pay back their debts with money that's worth less than when they borrowed it. On the other hand, lenders may lose out if the interest they receive doesn't keep pace with inflation. This dynamic influences interest rates and the availability of credit in the economy. Investments are also influenced by inflation. Stocks, real estate, and other assets may rise in value during periods of inflation, while fixed income investments like bonds can lose value. Investors often look for ways to protect their portfolios from inflation, such as by diversifying or choosing assets that tend to perform well when prices rise. Understanding inflation helps investors make smarter choices. Inflation is most visible in the prices you pay every day. From groceries to gas, rising prices can stretch your budget. Even small increases add up over time, making it important to track your spending and adjust your financial plans as needed. Being aware of inflation helps you make better choices about what to buy and when. Inflation is measured by government agencies and central banks. In the United States, the Bureau of Labor Statistics calculates the Consumer Price Index, while the Federal Reserve monitors inflation trends to guide monetary policy. These organizations collect data from thousands of businesses and households to get an accurate picture of price changes across the economy. Inflation is typically measured on a monthly and yearly basis. Monthly reports show short-term trends, while annual figures help us see the bigger picture. Policymakers and economists use this data to spot patterns, predict future inflation, and make decisions about interest rates and other economic policies. Most economists agree that a moderate level of inflation is healthy for the economy. Central banks often aim for an annual inflation rate of around 2%. This level encourages spending and investment without eroding purchasing power too quickly. Too little inflation can signal weak demand, while too much can destabilize the economy. Businesses must adapt to inflation by adjusting prices, managing costs, and sometimes renegotiating contracts. Rising costs for materials and labor can squeeze profit margins, while unpredictable inflation makes planning more difficult. Companies that manage inflation well can stay competitive, while those that don't may struggle. Consumers feel the impact of inflation in their wallets. As prices rise, you may need to make tough choices about what to buy and what to skip. Budgeting becomes more important, and finding ways to save money can help offset the effects of inflation. Being informed helps you navigate these challenges more effectively. Governments and central banks use various tools to manage inflation. These include adjusting interest rates, changing tax policies, and controlling the money supply. The goal is to keep inflation within a target range that supports economic growth while protecting consumers and businesses from runaway prices. Interest rates are a key tool for managing inflation. When inflation is rising, central banks may increase interest rates to slow down borrowing and spending. Higher rates make loans more expensive, which can help cool off an overheating economy. Conversely, lower rates can stimulate spending when inflation is low. Many central banks use a strategy called inflation targeting. This means they set a specific inflation rate as their goal, usually around 2%. By communicating this target, they help set expectations for businesses and consumers, making it easier to plan for the future. Clear targets also help build trust in economic policy. The Phillips curve is an economic concept that shows the relationship between inflation and unemployment. Generally, lower unemployment can lead to higher inflation, and vice versa. Policymakers use this relationship to help balance economic growth with price stability, though the connection isn't always perfect in practice. Stagflation is a rare but challenging situation where inflation is high, but economic growth is slow, and unemployment is also high. This combination makes it difficult for policymakers to respond, since the usual tools for fighting inflation can worsen unemployment, and vice versa. Stagflation was a major issue in the 1970s and remains a concern for economists today. Inflation rates can vary widely from country to country. Factors like government policy, economic structure, and currency stability all play a role. Some countries experience chronic high inflation, while others maintain low and stable rates. Understanding these differences helps explain why inflation is a global issue, not just a local one. The value of a country's currency is closely linked to inflation. When inflation is high, a currency may lose value compared to others, making imports more expensive and exports cheaper. Currency fluctuations can further influence inflation, creating a feedback loop that policymakers must manage carefully. Expectations about future inflation can influence actual inflation. If people expect prices to rise, they may spend more now, which can drive prices up. Businesses may also raise prices in anticipation. Managing expectations is a key part of keeping inflation stable and predictable. Inflation doesn't affect everyone equally. Borrowers may benefit if they repay loans with money that's worth less, while savers can lose out if their returns don't keep up with rising prices. Fixed income earners, like retirees, may struggle, while those with assets that rise in value can come out ahead. Understanding who wins and loses helps explain why inflation is such a hot topic. Inflation can have significant social effects. Rising prices can increase inequality. As low-income households spend a larger share of their income on essentials, social unrest can occur if inflation gets out of control, making it a key concern for governments and communities alike. Technology can influence inflation in both directions. Advances in technology often lower the cost of goods and services, helping to keep inflation in check. However, rapid technological change can also disrupt industries, leading to price swings in certain sectors. The relationship between technology and inflation is complex and evolving. Globalization has changed the way inflation works. International trade and supply chains can help keep prices stable by increasing competition and efficiency. However, global events like pandemics or trade disputes can disrupt supply and push prices higher. Understanding globalization's role is key to grasping modern inflation. Housing costs are a major component of inflation. When home prices or rents rise, it can have a big impact on the overall inflation rate. Housing inflation affects both homeowners and renters, influencing decisions about where to live and how much to spend on housing. Food prices are another key driver of inflation. Factors like weather, transportation costs, and global supply chains can all influence what you pay at the grocery store. Rising food prices can hit low-income families especially hard, making food inflation a major concern for policymakers. Energy prices, like oil and gas, play a big role in inflation. When energy costs rise, it affects transportation, manufacturing, and even the price of goods on store shelves. Energy inflation can be volatile, making it a key area to watch for signs of broader inflation trends. Healthcare costs are rising in many countries, contributing to inflation. Medical services, insurance, premiums, and prescription drugs all factor into the inflation rate. Rising healthcare costs can strain household budgets and make access to care more difficult for some people. Education costs, including tuition and fees, have risen faster than general inflation in many places. This makes it harder for students and families to afford higher education and contributes to the overall inflation picture. Policymakers are increasingly focused on education inflation as a social and economic issue. Planning for retirement means thinking about inflation. Over decades, even low inflation can erode the value of savings and fixed income. Retirees need to consider how to protect their purchasing power, often by investing in assets that can keep up with or outpace inflation. There are ways to protect yourself from inflation. Diversifying your investments, keeping an eye on interest rates, and budgeting carefully can all help. Some people invest in assets like real estate or stocks, which may rise in value during inflationary periods. Staying informed is your best defense. History offers many lessons about inflation. From the hyperinflation of Weimar Germany to the stable prices of recent decades, past experiences shape how we think about inflation today. Studying history helps policymakers and individuals prepare for future challenges. There are many myths about inflation. Some people think all price increases are bad, or that inflation always leads to economic disaster. In reality, moderate inflation is normal and even healthy for a growing economy. Understanding the facts helps you make better decisions. You can track inflation by following official reports, like the Consumer Price Index, and by keeping an eye on the prices of goods and services you buy regularly. Many financial news outlets and government websites provide up-to-date information on inflation trends. Looking ahead, inflation will continue to be a key issue for economies around the world. Factors like technology, globalization, and policy decisions will shape how inflation evolves. Staying informed and adaptable will help you navigate whatever the future brings. To sum up, inflation is the general rise in prices over time, affecting everything from your daily expenses to your long-term financial plans. Understanding what causes inflation, how it's measured, and how it impacts you is essential for making smart decisions. By staying informed, you can better protect yourself and plan for the future. Thanks for joining us on this journey through the world of inflation. Whether you're a student, a worker, or a retiree, inflation touches every part of your life. By understanding what it is and why it matters, you're better equipped to make choices that protect your financial well-being. Stay curious, stay informed, and remember, knowledge is your best tool against uncertainty.